Imagine you're right there, about to launch a new business. Or maybe you're looking at a really big project investment. How do you actually know if it's going to work out financially? I mean, beyond just, a gut feeling or even basic profit numbers, how do you really get to the core of its financial health? Today, we're doing a deep dive into exactly that. We're exploring financial viability, specifically using cash flow analysis and some really quite powerful metrics. We're drawing heavily from a comprehensive quick guide on cash flow analysis to sort of unpack how businesses decide where to put their money.
Yeah, and building on that picture, what's really fascinating, I think, is how we can shift from those gut feelings or even simple accounting to genuinely understanding the long-term economic pulse of an investment. We want to give you a shortcut, really, to grasping the tools and the thinking that goes into real-world financial decisions, so you feel enlightened, not just, buried in numbers.
Okay, so let's kick things off with the basics then. When we say cash flow analysis, what are we actually talking about? What does it mean at its heart?
At its heart, it's really about tracking the money. It's the process of accounting for all the cash flowing into a project that's your revenues and all the cash flowing out. And that outflow includes both the initial big spend, the investment, and the ongoing costs to keep it running. You track this over a set time period to see if the whole thing makes economic sense. Is it viable? We mainly look at three key things. First, CapEx. That's your capital expenditure, the big upfront investment. Second, OpEx, operational expenditure. Those are the costs to run things day to day. And third, revenues. That's the money the project actually brings in.
Right. CapEx, OpEx, revenues. Okay. So to make this more concrete, let's use that example from the guide. A hypothetical 10-year project. It has an initial CapEx, that capital spend, of 100,000 Brazilian reais. Let's just call it 100K raise. Then every year, the OpEx, the running costs, are 20K raise. But importantly, it also generates 60K raise in revenue each year.
Exactly. So if you figure out the net cash flow each year after that first investment hit, well, it's 40K raise per year. That's simply the 60K revenue minus the 20K OpEx. You can picture it like arrows. Money in, arrows up. Money out, arrows down. And if you add up all that net cash flow over the full 10 years for this project, you get a positive 300K raise. So on the surface, it looks profitable.
Okay, so 40K raise coming in reliably each year after year one. The first question anyone asks is, okay, great, but when do I get my initial 100K back? How do we figure that out quickly? And what does that number really tell us? Or maybe what doesn't it tell us?
That leads us straight to simple payback time. It's exactly what it sounds like. The point in time where the cash you've accumulated from the project equals your initial investment. Basically, when the project has paid for itself in simple terms, for our example, you just take the 100K CapEx, divide it by that 40K net annual cash flow.
And you get 2.5 years.
Yep, 2.5 years, which sounds pretty good, right? A quick return. It gives you a sense of how fast you get your cash back, your liquidity, but, and this is a big but, relying only on simple payback. It's a bit like trying to drive looking only in the rearview mirror. It completely ignores a fundamental concept in finance, something that really dictates true value over time, the time value of money.
Ah, yes. The time value of money. This is where things get, well, a lot more sophisticated, but also much more realistic, doesn't it? It sounds kind of academic, but it has huge real-world
It's
consequences.
absolutely massive. It forces you to ask, is a reel today actually worth the same as a reel you expect to get, say, 5 years from now? Financially speaking, the answer is definitely no. Money you have today has potential. It can earn interest, it can be invested, it can grow. So a reel today is inherently more valuable than the promise of a reel in the future. And that's even before we talk about inflation.
Can you give us a quick illustration of that?
Sure. Imagine you invest one reel today at a 10% annual interest rate. Compounding over 10 years, that one reel becomes 2.59 reais. Now, contrast that. If you only invest that same one reel 5 years into that 10-year period, by the end, it's only grown to 1.61 reais.
Wow, quite a difference.
Huge difference. It's all about the time it has to grow. So money today, its present value, P, grows over time with an interest rate to become a larger future value F. The formula is F equals P times 1 plus I to the power of N. And if you want to know what future money is worth today, you just flip it. P divided by 1 plus I to the power of N.
So you're discounting the future value back to the present.
Exactly. You're
Yeah.
discounting it. And this isn't just some theory. It's absolutely
Yeah.
fundamental for properly evaluating any investment that stretches out over time. You have to account for that earning potential.
Okay, so it's not just what you earn, but crucially when you earn it. That changes the game. So now that we understand the time value of money, we can use more powerful tools. Let's start with net present value, NPV, or VPL in Portuguese, as our source mentions.
Precisely. NPV, Net present value. This is arguably the gold standard for assessing project profitability because it directly incorporates the time value of money. What it does is it takes your initial investment, which is already in today's money, right? It happens now at time zero. And it combines that with the present value of all the future cash flows a project is expected to generate.
Okay, but how do we calculate that present value of future cash flows? You mentioned discounting.
Right. We use a discount rate, often called I. This is super important. It might also be called the minimum attractiveness rate, or TMA. For companies, it's often based on their WACC, the weighted average cost of capital.
WACC, weighted average cost of capital. What's that, basically?
It's essentially the average cost of all the funding a company uses, money from shareholders, loans from banks, etc. It represents the minimum return the company needs to earn on an investment to satisfy its investors and lenders. Typical rates might be, say, 8% to 12%. For our examples today, let's just assume a rate of 10%.
Okay, 10% discount rate. So how does that apply to our 40K per year project?
Well, each of those future 40K raise payments needs to be discounted back to what it's worth today using that 10% rate. Remember our time value example. That 40K profit you get in year one, it's only worth about 36.4K raise today. And the 40K you get way out in year 10, that's only worth about 15.4K raise in today's money.
Wow, it shrinks quite a bit over time.
It really does. So for the NPV, you calculate the present value for each year's 40K cash flow, then you sum all those present values up. Then, critically, you subtract the initial 100K CapEx, which is already a present value because it happens at the start. When you do all that math for our example project, the total NPV comes out to a positive 145.8K raise.
Positive 145.8K. So what does that number actually tell us? Is it just good because it's positive? How do we use that to make the call?
The decision rule is pretty straightforward. If the NPV is less than zero, the project is actually destroying value relative to your cost of capital. You shouldn't do it. If NPV is exactly zero, well, you're earning exactly your required rate of return, but no extra economic value. Kind of different. But if the NPV is greater than zero, like our 145.8K, that means the project is expected to generate more value than its cost. It's economically viable, it creates wealth.
So positive NPV is the green light.
It's the green light, yes. And importantly, it tells you how much value is being created in today's terms. What's really interesting, too, is how sensitive NPV is to that discount rate. If we used a higher rate, say 15%, that NPV would drop significantly because future cash becomes worth even less today.
That makes sense. Higher hurdle rate, harder to clear.
Exactly. And one more point on NPV. If you're comparing projects with really different initial investment sizes, just looking at the absolute NPV might be misleading. A better approach there could be to look at the NPV divided by the CapEx. It gives you a sense of value generated per unit of investment, sort of a bang for your buck measure.
Okay, good tip. Now, we talked about simple payback being too simple because it ignores time value. Is there a version that does account for it?
There is, yes. It's called discounted payback time. This metric calculates how long it takes for the discounted accumulated cash flows, the ones brought back to present value, to reach zero and start turning positive. So it tells you when the investment really pays for itself, considering the time value of money.
How does that compare for our example? Simple payback was 2.5 years.
Right. But the discounted payback for that same project, using our 10% rate, is actually 3.0 years.
So half a year longer.
Exactly. It takes longer to recoup the investment in present value terms. That half-year difference really highlights the impact of discounting. Generally, companies like to see discounted payback under 3 years if possible. For really big long-term projects, maybe up to 5 years might be acceptable, but quicker is usually better.
Makes sense. Okay, one more key metric often used, especially for comparing different options. The internal rate of return, or IRR, TIR in the source material. What's the idea behind IRR?
The IRR, or internal rate of return, is a really popular one. What it represents is the specific discount rate at which the net present value, NPV, of a project equals exactly zero. Think of it this way. It's the effective rate of return that the project itself is generating internally on the invested capital. It's expressed as a percentage.
How do you find that rate? It sounds like it might involve some trial and error.
It usually does, yes.
Yes.
It's calculated iteratively. You basically keep trying different discount rates until you find the one that makes the NPV calculation hit zero. Luckily, spreadsheet software like Excel has built-in functions, like IRR or TIR, that do this instantly. For our ongoing example project, the IRR turns out to be 38%.
38%. Okay, how do we use that? Is it just higher is better?
Pretty much, but you compare against your benchmark. The decision rule is, if the IRR, 38% in our case, is greater than your minimum attractiveness rate, TMA, which we assumed was 10%.
Then the project is attractive.
Exactly.
Yeah.
It's generating a return well above your cost of capital or required return. If the IRR was less than the TMA, you'd reject the project. If it happened to be exactly equal, well, the decision would be up to the investors, similar to a zero NPV.
What's the big advantage of IRR then?
Its main strength is that it's a single percentage figure. It's intuitive. People understand rates of return. It makes it really easy to compare different projects, even if they have different scales or lifespans. You can just rank them by IRR.
Are there any pitfalls with IRR? Any situations where it might be tricky?
Yes, there's a critical one to watch out for.
Mhm.
If the project's cash flow stream changes sign more than once, meaning it goes from negative investment to positive returns and then back to negative again, maybe for decommissioning costs or something, you can actually get multiple IRR values mathematically.
Oh, that sounds confusing.
It can be very confusing. It makes the IRR unreliable in those specific cases. So if you have unconventional cash flows like that, you need to be cautious and rely more heavily on NPV, which doesn't have that multiple solution problem.
That 38% IRR still sounds fantastic, though. But your caution makes me wonder, could a really high IRR sometimes give a false sense of security? Like, if the project is super risky or the cash flows are really front-loaded?
That's a really sharp point. Yes, absolutely. A high IRR doesn't tell you about the scale of the project or the absolute value created like NPV does. You could have a tiny project with a massive IRR, but it might not contribute much overall value compared to a larger project with a decent but lower IRR. And as you mentioned, if the cash flows are very irregular or if there's significant risk not captured in the discount rate, just looking at the IRR number alone could be misleading. It's powerful, but best used alongside NPV and payback analysis for a complete picture.
Okay, fantastic. We've got CapEx, OpEx, revenue, simple payback, time value of money, NTV, discounted payback, and IRR. That's quite the toolkit. Now, let's see how this all comes together in practice. How would we use these concepts to evaluate something much bigger, like, say, building a whole new industrial plant?
Right, this is where the rubber meets the road. The source material gives a great step-by-step example for exactly this, building a detailed cash flow for an industrial project. It pulls all these pieces together beautifully. So step one is defining the timelines. How long for construction? How long for operation? Construction might take, say, 1 or 2 years. Let's use 2 years for our example, years 1 and 2. And let's say year 0 is when we buy the land, even before construction starts. Then operation. For big plants, this could be 10, 20, even 30 years. We'll stick with 10 years of operation, so that would be years 3 through 12 in total.
And these are just assumptions you can change later.
Exactly. Totally flexible. You can run different scenarios. Step 2 is putting in the numbers for OpEx and revenues during that operational phase and calculating the gross profit, which is often called EBITDA.
EBITDA, earnings before interest, taxes, depreciation, and amortization.
That's one. So let's say annual revenue starting in year 3 is 60 million raise. Annual OpEx is 20 million. Simple subtraction. 60 minus 20 gives us an EBITDA of 40 million raise per year during operation.
Okay, straightforward enough. Now, step 3 gets into something you mentioned, depreciation. How does that work here?
Right, accounting depreciation. This represents the cost allocated to the wear and tear or devaluation of the plant's assets, the equipment buildings which are part of the initial CapEx. Now, the absolutely crucial thing to remember here is that depreciation is a non-cash expense. No actual money leaves the company's bank account because of depreciation itself.
So why include it?
For tax purposes. In many places, like Brazil, as mentioned in the source, you can deduct depreciation from your earnings before you calculate income tax. It acts as a tax shield. Let's say the total depreciable CapEx is 100 million reais, ignoring land for now, and it's depreciated linearly over 10 years with no salvage value. That's 10 million reais in depreciation expense per year. You subtract this 10 million from the 40 million EBITDA to get your EBIT earnings before interest and taxes, which would be 30 million.
Got it. Lower taxable income thanks to a non-cash charge.
Yeah.
All right, what's step 4 then? Taxes.
Exactly. Step 4 is calculating the taxes. First, you'd normally deduct any interest paid on debt, but our example assumes the project is fully equity financed, so interest is 0. That means our EBT, earnings before taxes, is the same as EBIT, 30 million. Now apply the tax rate, let's say 34% as in the source. So 0.34 times 30 million is roughly 10.2 million reais in taxes. Let's round to 10 million for simplicity. So you have 30 million EBT minus 10 million in taxes, leaving 20 million. But here's the key move.
Ah, you add back the depreciation.
You got it. You add back that 10 million depreciation because it wasn't real cash going out the door. It's just used to calculate the tax.
Yeah.
So 20 million after-tax profit on paper plus 10 million depreciation add back gives you 30 million raised per year. That's your operational free cash flow. The actual cash generated by the operations after taxes.
Okay, that makes sense. The add back is critical. Now, step 5. What else goes into the cash flow?
Step 5 is about bringing in the expenses during construction and other important cash flows that happen outside the regular operations. First, the CapEx itself. That 100 million raised investment in the plant doesn't usually happen all at once. It's spread over the construction period. So maybe 50 million in year 1 and 50 million in year 2. These are big negative cash flows early on. Then, the land purchase we mentioned. Let's say 1 million raised spent in year 0 right at the very beginning. Negative cash flow.
And the land value comes back at the end, you said?
Yes, this is important. Unlike equipment, land typically isn't depreciated. It's assumed you can sell it at the end of the project life, maybe for its original cost or even more. So that 1 million raise comes back as a positive cash inflow in the final year, year 12 in our case.
Okay, what else?
Working capital, or capital to zero. This is the money tied up in the day-to-day operational cycle. Things like cash on hand, inventory of raw materials, accounts receivable. You need this to get operations started and keep them running smoothly. It's often estimated as a percentage of CapEx or revenue. Let's say it's 5% of the 100 million CapEx, so 5 million REIs. This is usually required when operations start, so maybe it's a negative cash flow at the beginning of year 3.
And does that come back too?
Yes, generally it's assumed that this working capital is recovered or released in the final year of the project, year 12, as you wind down operations and collect final receivables, sell off remaining inventory, etc. So that 5 million also comes back as a positive inflow at the end.
Right, so that final year's cash flow gets a significant boost from selling the land and recovering the working capital.
Exactly. It makes the cash flow pattern less uniform than our simple initial example. You have big outflows at the start, steady inflows during operation, and then a larger inflow in the final year.
Okay, we've built this complex, realistic cash flow stream. What's the 6th and final step?
The final step is to bring back our key metrics. You take this complete free cash flow timeline with CapEx, land, working capital, operations, taxes, depreciation add back, end-of-life recoveries, everything, and you calculate the NPV, IRR, and discounted payback time for the entire project.
Using that 10% discount rate we talked about.
Yep, assuming that's still our TMA. When you run the numbers for this industrial project example from the source, the overall NPV comes out to a positive 61.3 million REIs.
Positive, so that's a definite go.
Looks very viable, yes. It's expected to create substantial value. The IRR is calculated at 22.1%.
Also good, right? Higher than the 10% TMA.
Much higher.
Oh.
Very attractive return. And the discounted payback time. It comes out to 4.9 years. Now remember, this is often measured from the start of operations, year 3 in our case.
4.9 years from start of operation, is that acceptable?
For a large industrial project like this, yes, that's generally considered within acceptable limits. Remember, we said up to 5 years might be okay for big ventures. So putting it all together, this detailed analysis confirms the project isn't just profitable on paper, it's economically viable and attractive when you consider the time value of money and all the relevant cash flows. It gives a much, much richer picture than just looking at simple payback or basic profit.
Wow. Okay, so wrapping this up for our listener, what's the big takeaway here? We've journeyed from simple cash in cash out to NPV, IRR in this complex industrial case. It really seems crucial to move beyond those surface level numbers, doesn't it?
Absolutely. I think the key is understanding why these tools matter. You've seen that the time value of money isn't just theoretical, it's essential for accurate valuation. You've seen how things like depreciation, while not cash out, have a real cash impact through taxes, and how easily overlooked items like land and working capital recovery significantly affect the total cash picture. Armed with this, you can really start to critically evaluate investment claims or proposals, looking beyond the headline numbers to the underlying economic reality.
It really is a framework that lets you look at almost any financial decision, big or small, whether it's personal finance or a huge business investment, with a much clearer, more informed eye. You can separate the wishful thinking from the actual value proposition.
So maybe a final thought for you, the listener, to chew on. Think about a project you've considered recently. Could be anything, maybe upgrading your home, investing in a certification, even just planning a big trip versus saving. How might your view of that project change if you tried to apply even a simple discounted cash flow lens? What's your personal discount rate or minimum required return? What hidden costs or future benefits might you uncover if you really map out the cash flows over time? It might surprise you.
Great question. Keep digging, keep questioning those assumptions, and keep making those informed financial decisions.